2008 changed everything. We're at this point, like Lynn Alden talks about, nothing stops this train. The government printing is now bigger than the economy. We can see it's going parabolic. We're accelerating. So if you go from 2018 to today, the US money supply has grown by 8%. But from 2019, it's grown by 10%. Now we can see about 75% of the debt is about a 3 to 5 year maturity, about 4 years. It just happens to be synced up with the 4-year Bitcoin halving cycle. It happens to be synced up with the US presidential cycle. And on year 3, when the debt's being refinanced, there's not enough liquidity, so the market starts drawing down. The only way we have a recession at this point is by policy choice. But of course, no politician is going to choose that. The government can't afford a recession. What happens with the government if their revenues drop by 30, 40%? Archie. I think the global macro picture is important to understand, though, in regards to this, because we've been talking about like the 4-year Bitcoin cycle, but that's like the tail, wagging, or the dog's wagging the tail, so to speak, right? So it's like you can't really look at this in isolation. I think the macro cycle is what's the dog here, right? And so what happened is you have all this debt. We both talked about like 2008, the great financial crash. And you said something that in Australian real estate, you were expecting for it to crash, but it never did. It's continued going up for 30 years. And if we go back to that and we understand why, so you understood that the banks aren't fractionally lending, they're just printing money. And so really what happened is 2008 changed everything. It's sort of like BC and AD, in my opinion. And so a lot of times people are going back to, well, the 1970s and the 1930s and then 1808, it's like everything changed. And what changed is, back to the point of the housing, what we saw in previous drawdowns, the Great Depression in the 30s or the 70s or the year 2000, the dot-com crash, the central banks allowed the deleveraging to happen. Well, let's just ride this thing out. And sure, they tried to manipulate a little bit, but they basically tried to let it happen. In 2008, they also tried to allow it to deleverage, but it started to be systemic. It was the great financial crash, the banking crisis was happening. And so if you look at this in terms of time, for example, you can see that in the United States, like housing construction, housing markets sort of drive most of the economy. And housing starts were down 28%, a massive crash. But yet the government did nothing for almost 3.5 years. When Bear Stearns collapsed, which was basically known as the trigger that caused the entire banking collapse to happen, it took 7 months before any bailout even happened. So they were trying to allow it to kind of happen, but it kept getting worse and worse. There was like no bottom, right? And I remember when they announced that the TARP bailout was like $700 billion. I was like, no, like you can't do this. As today, that's not even a drop in the bucket.
800 billion used to be a lot of money.
Yeah, it used to be a lot of money. But what happened is 2 things happened. So number one, it showed that the system was too levered up at that point to allow it to deleverage. And then what happened is then they over-leverage it more. If you look at the Fed balance sheet in 2008, it's like a straight up wall, right? We had about $4 or $5 trillion at that point. And so now the system got 2 things happened. One, it got so levered up now that there's no way it can deleverage. But also number 2 is it changed just the psychology and the appetite of the governments to allow it to deleverage. So we can look forward, if we look at 2020, they shut the whole world down and we had the markets crash, but this time it took 3 months before they blew the thing back up sky high, compared to in 2008, from the market peak to back the dip and back to market peak was 7 years. In 2000, it was 15 years. 2008 was 7 years. In 2020, it was 3 months. In 2023, we had 3 banks in the US collapse. It took 6 days for a bailout. The US is running $2 trillion deficits, $1 trillion every 90 days right now, on a $7 trillion budget. 3% debt to GDP right now. And so we're at this point, like Lynn Alden talks about, nothing stops this train. We're at a point of fiscal dominance. It's the government printing is now bigger than the economy, right? And so the only way we have a recession at this point is by policy choice. The governments are driving the economy and they choose if we want a recession, but of course no politician is going to choose that, right? There's no appetite for that. They've proven that. And so I think a couple things are important to understand. Number one, back to 2008 being that starting point. What happened is pre-2008, you had all this debt from 30-year bonds to short-term debt, right? And it's all over different terms at different rates. But in 2008, it's sort of like a metronome that keeps perfect time of music. If I have metronomes that keep perfect time, if I put 100 of them on a table and start them all at different times, there's this phenomenon where they'll all get synced up together. So you have all this debt, but all the banks around the world called everyone on the same day and said, hey, we'll refinance you to zero. Do you want to do that? and everybody refinanced their debt, and it synced up all that debt. And right now we can see about 75% of the debt is about a 3 to 5 year maturity, about 4 years. And that started on 2008. It's 2008, 2012, 2016, 2020, 2024. That just happens to be synced up with the 4 year Bitcoin halving cycle. It happens to be synced up with the US presidential cycle. It happens to be synced up with the 4 year ISM business cycle, are all in that time frame. So really what we have is this debt having to be reset every 4 years. And on year 3, when the debt's being refinanced, there's not enough liquidity. So the market starts drawing down. The next liquidity tranche gets pumped in and the markets take off again. Michael Howell, he's sort of what I would consider the GOAT in the global liquidity cycle. He says it's more of like a 5 year cycle, but somewhere in that time frame. So the question is, number one, back to the housing in Australia, it never went down, again, because when you increase the money supply, the asset prices go up. And I think a lot of people are still in this Benjamin Graham world trying to understand prices and trying to think if they're going to revert back to the mean. Will the houses get back down to that point again? But they're looking at prices based off of historical prices and not understanding liquidity in the system. As long as that liquidity stays in the system, the prices can't drop back down. I mean, sure, they'll fluctuate a little bit, right? And so what happened in 2008 is the liquidity sucked out, the prices came down, but then the liquidity went back up, right? And so we have to understand it from that mechanism. And so we have to, stop thinking about prices from historical means and start thinking about it in terms of liquidity in the system. So then the question to be asked is, well, how much liquidity will be in the system? And so the United States, the CBO, Congressional Budget Office, they tell us for the next 30 years through 2054, they tell us what the deficits will be, what the debt will be, and they tell us what that will be, right? And we can see it's going parabolic. And we can see other nations around the world, China right now, massive easing going on, the ECB, massive easing going on, and so liquidity is going up. And so it's really hard to tell the future. But I would say, number one, the 4 year sort of liquidity cycle isn't intact until proven otherwise. But we will only know once we get to Q4 and see what the banks are still doing. Number two, I would say that it looks like, to me, though, the appetite for that recession is gone. Does it mean that we'll never see prices go down again? Of course not, right? But I think we're potentially going to be past that big 4 year cycle. But we'll know a quarter at a time.
I think one of the things, in addition to Wall Street demanding bailouts every time the markets are jittery, is we have a generation of boomers who essentially, they understood that Social Security was not going to be there for them, and the government policy effectively corralled them into investing into either stock market or real estate. And so this whole generation, which is still in power, they can't see through an 18 months, 24-month recession. So it's been incumbent on the government to not leave them destitute. Their peers essentially creating policy for their own benefit. And so people like me and younger people who have not been able to get the benefit of these cycles that have been, throughout history of recession booms and busts, clearing out excess. And instead, we've had the liquidity pumps assuring boomers of high asset prices being maintained to fund their retirements. So I'm just wondering, how long before?
I think that's only one part of it, though.
Yeah.
So that's only one part of it. So first of all, I would say people look back at look how cheap homes were 20 years ago. In 20 years from now, we're going to say the same thing. So you think it's like these liquidity pumps, it's not going to continue? The rate of money growth won't be accelerating from here? If you look back over the last 20 years, you can draw a trend line on the money growth here, and then the trend line went like this, and the trend line went like this, and the trend line. So we're accelerating. So if you go from 2018 to today, the U.S. money supply has grown by 8%, but from 2019 it's grown by 10%, right? So the rate of growth is accelerating. So it's not like, oh, they benefited from this. We're going to benefit from, we're all benefiting from it. You're just looking at hindsight, not thinking about the future, number one. But I would say it's bigger than just the retirement savings. It is important, yes. And so I would guess if you asked most people, even young people, would you rather your entire net worth get cut in half? You lose your job, you lose your business, your job pays you half as much, but gas is a little bit cheaper? Or would you rather your assets go up in value, your business takes off, and you keep your job and maybe get a raise, but gas goes up by 50%? I think everybody would rather see the growth even if prices got a little bit higher. So I think politically, it's a more stable. And I think that's the point you're making. But it's bigger than that, right? So again, because we're in a debt-based monetary system, two things. Number one, the money supply grows through debt issuance. When the money supply grows through debt issuance, the money, the dollars are the liability, but the debt is the asset. And the debt becomes collateral for more debt. So it's not like, oh yeah, let the baby boomers screw the retirement, whatever, let's save the, no, it's not about that, because all that debt is collateral for more debt. So the entire system implodes, the entire banking system implodes, the entire system implodes, number one. But number two, the governments, even though they print money, they still need tax revenue, right? The U.S. is running a $2 trillion deficit. They can't just print, they could, if they printed $7 trillion a year, right, what would happen, right? So like in a normal recession, in a normal recession, not even a deep recession, the U.S. tax receipts will drop 12 to 15%. So because the government, a big chunk of the revenue comes from cap gains. It comes from the stock market. If you overlay the stock market with revenues, they're like exactly correlated. So if asset prices come down, home prices, stock prices, et cetera, the government revenues will plunge. And they can't afford that. So the government can't afford a recession. So it's not even about saving baby boomers. Yes, that's important politically, but it's more important because what happens with the government if their revenues drop by 30, 40%?
Well, but historically we've had recessions and governments have had to make do with that, right? Whereas it feels like the last 15 years, we've just said no more recessions.
Yeah, but governments used to run on surpluses. When Bill Clinton was a president, the U.S. had a surplus. Today, we have a $2 trillion deficit. That's a big difference, right? When you're putting 10% of your earned income in savings every month, you can weather a 30-day, 60-day financial storm. When you're running off all your credit cards and you're maxed out, you don't have the buffer room. So it's just a lot different today. We used to have those recessions when the system wasn't as levered up, so it wouldn't collapse as fast, number one. Number two, the government had a surplus, not a recession. Number three, we were at 40, 50% debt to GDP ratios. Today we're at 123.
I'm familiar with all those numbers and I'm just like, okay, but there was a point we went from surplus to deficit. Yeah. Is that just a coincidence that the timing of that is when the boomers started retiring?
Well, certainly demographics play a big piece of that.
Because they're still the largest demographic in the United States, at least. I'm pretty sure that's also the case in the United Kingdom.
In the developed world, it is. The U.S. had like a echo boom, so the millennials are about the same size as the baby boomers, but yeah, the developed world is about the same. But yes, we have a massive depopulation happening. I don't want to say depopulation is some agenda to kill people off, but just demographics are trending down. And so we have less people in the workforce. So like, for example, in the United States, that's down to about 60%. And so when you have less people participating, that's less growth. Less businesses, less growth happening. And so then we have to make up for that growth with deficit spending. It's a big piece of it.